This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, August 13, 2026, and this is the New York pre-market. Now, let's get into it. We are watching a market that is essentially holding its breath. The S&P 500 is grinding higher, but don't let the green numbers fool you. The engine room is screaming. The Nasdaq 100 ETF is up nearly 0.75%, while the Dow is flat, and the Russell 2000 is barely ticking along. This isn't a broad rally. It's a tunnel vision event where technology carries the entire index on its back, while consumer spending and small caps sit on the sidelines. As of 12:35 ET on Thursday, August 13, 2026, the question isn't whether the bulls are in control, but how much structural damage is happening underneath the surface. Let's look at the tape. Before we dig into the charts, here is what is moving the needle today. We have earnings reports hitting the wire for Appian Corporation and eBay Schmidt Holding, though neither carries significant institutional weight compared to the macro backdrop. More importantly, we are tracking the pre-market movers that set the tone for this session. HPQ, Dell, and HPE are all gapping up following Lenovo's strong quarterly growth report, signaling renewed confidence in hardware infrastructure. Conversely, TPR is down over 14%, and Yeti is off 7.5% despite positive guidance, a clear signal that the market is punishing retail-facing names regardless of fundamentals. Apex, how do you contextualize these moves?
These moves confirm the fragile strength dynamic I outlined earlier. The HPQ and Dell gains are purely sector-specific, tied to AI infrastructure demand, while the TPR and Yeti declines highlight a market that has lost patience with consumer cyclicals. It reinforces that capital is not chasing broad growth. It is hunting for specific high-margin tech exposure while abandoning anything related to discretionary spending.
That brings us to the core market snapshot. SPY is trading at $772.49, up 0.25%. QQQ is at $723.70, up 0.73%, and the Dow Jones Industrial Average is effectively flat at $537.15. The VIX is suppressed at 15.28. Grid, give me the technical posture of these three indices right now.
Technically, SPY is testing the upper boundary of its recent consolidation. We're seeing price action at $772.49, sitting just shy of the August 12 intraday high of $774.90. Holding above the August 12 low of $771.28 is the absolute baseline for bullish structure. A break below that invalidates the short-term setup and opens the door to a deeper retracement. Meanwhile, QQQ is in a tighter coil. At $723.70, it is consolidating between the August 10 low of $720.33 and the August 12 high of $727.25. That range is narrowing, which usually precedes a directional expansion. If QQQ clears $727.25, we see momentum. But failure to hold $720.33 exposes the lack of underlying support.
I have to jump in here, Grid. You're talking about consolidation zones and technical floors, but you're missing the sentiment disconnect. The VIX is at 15.28, which screams complacency. We have extreme bullish sentiment concentrated in the AI theme, a plus 0.67 sentiment score. And yet, consumer discretionary is down 1.13%. You cannot ignore that bifurcation. The market is pricing in a consumer recession while simultaneously bidding up tech multiples. That is a fragile bull configuration. If sentiment turns on the consumer side, the tech support levels you're watching become irrelevant because the broader market context will collapse.
And that brings me to the fundamental erosion, pulse. Grid focus on $771.28 as a defense line ignores the fact that the S&P 500's health is entirely dependent on the technology sector, which is up 1.49% today. Look at the macro data. GDP is growing at a sluggish 1.5% annualized, and non-farm payrolls declined by 23K month over month. We have a flat 10-year, 2-year yield curve at plus 0.48 pp. This is not a healthy growth environment. The fact that the technology sector is rallying while consumer discretionary and the materials sector, materials, down 1.24%, are getting crushed tells me that institutions are de-risking. They aren't betting on economic expansion. They are betting on monopoly margins in AI. If NVDA, the driver of that plus 0.58 sentiment score, stumbles, there is no fundamental base to catch the fall.
Exactly, CIPHER. And let's call this what it is: a valuation bubble supported by artificial liquidity. You're all focusing on SPY holding $771.28, but the yield curve is flattened to plus 0.48 pp, and core PCE is stuck at 3.29%. The market is pricing in a soft landing that the GDP and payroll data explicitly reject. The Russell 2000 IWM is at $302.71, lagging QQQ significantly. Why? Because small caps are leveraged. When the yield curve flattens and credit conditions tighten, they get choked off first. This narrow market rally is exhausting itself. The fact that consumer discretionary is down 1.13% and communication services is down 0.9% means the breadth is gone. Once the AI narrative hits a wall, there is no sector left to prop up the index.
So we have a clash between technical structure and macro fundamentals. Let's zoom in on the specific asset classes driving this divergence. First, let's look at the technology sector ETF. It is the undisputed leader today, up 1.49%. CIPHER, walk us through the fundamentals of this move. Who is buying?
It's pure concentration. We are seeing massive inflows into NVDA and MSFT, driven by that plus 0.58 and plus 0.42 sentiment scores, respectively. But look at the earnings quality elsewhere. TPR gap down of 14.2% despite beating estimates, and Yeti down 7.5% on raised guidance. This is sell the news on steroids. Investors are refusing to commit capital to anything outside the Magnificent Seven. They want direct exposure to AI infrastructure, which is why the technology sector is surging while the rest of the market drags. It's a flight to quality in a shrinking universe.
On the chart, CIPHER, that concentration shows up as a parabolic run-up with low volatility. The technology sector is pushing through resistance levels with minimal pullback, which is typical of a sentiment-driven squeeze. However, look at the relative strength. QQQ is outpacing SPY by almost 50 basis points. That confirms the narrow leadership thesis. The technical setup is strong, yes, but it's fragile. If the technology sector hits resistance around the $189 area, which aligns with the 1.49% daily gain, we could see a rapid unwinding because there are no buyers in consumer discretionary or communication services to absorb the profit-taking.
And that's where the sentiment trap lies, grid. You're looking at the chart, I'm looking at the crowd. The NVDA sentiment score is plus 0.58, but check the put/call ratios. If hedging activity is spiking for NVDA and MSFT while the price keeps climbing, that's a classic divergence. The smart money is buying insurance while the retail crowd is chasing the breakout. Given that the VIX is suppressed at 15.28, this complacency is dangerous. One bad headline regarding AI regulation or chip supply, and that sentiment flips instantly. The crowd is overextended on the long side, leaving little fuel for the next leg up.
Or, as I've been saying, the crash is coming from the wrong direction. It's not the headline risk, it's the yield curve. The 10-year yield is 4.7%. That is toxic for long-duration assets like the technology sector. The market is pretending that rate cuts will save the day, but with CPI at 3.3% and core PCE at 3.29%, the Fed is trapped. You cannot cut rates without reigniting inflation, but you cannot hold rates high without killing GDP, which is already at 1.5%. The technology sector is running on fumes. It's a singularity play. Once the 10-year yield ticks up even 5 basis points, that valuation multiple collapses.
Let's pivot to the laggards, specifically consumer discretionary, which is down 1.13%. This seems to be the epicenter of the macro weakness. SPECTER, you mentioned this early. Why is consumer discretionary getting hammered?
Because consumer discretionary is the canary in the coal mine for the entire equity market. It's down 1.13%, and let's look at the components. Retailers are struggling with margin compression and weakening demand. But more importantly, look at the cross-asset correlation. The trade-weighted dollar index is at 119.6, down 0.45 week over week. A weaker dollar usually helps exporters, but it adds import inflation. With core PCE at 3.29%, consumers are feeling the pinch. The minus 23K decline in non-farm payrolls means fewer people are shopping. Consumer discretionary isn't just a sector trade. It's a proxy for the American consumer's solvency. If consumer discretionary continues to bleed, it validates the 1.5% GDP growth forecast. We are entering a slowdown, and consumer discretionary is paying the toll.
I agree with the macro link, but I'd add the earnings filter. The gap down in TPR and Yeti is the microcosm of the macro problem. Companies are raising guidance. Yeti raised its 2026 outlook, but the market is still selling off. That implies that even good news isn't good enough anymore. Investors are discounting future cash flows at a higher rate due to the sticky inflation data. It's not just that consumers are broke. It's that the cost of capital has risen effectively, even if the nominal rate hasn't moved much. Consumer discretionary is caught in a vice between rising input costs and falling volume.
Technically, consumer discretionary is breaking key support. The minus 1.13% move is decisive. In terms of relative performance against QQQ, consumer discretionary is underperforming by roughly 2 percentage points today alone. That's a massive divergence. Usually when a sector rotates out this hard, it doesn't bounce back quickly unless there's a broad market reset. The volume profile on consumer discretionary sell-offs suggests institutional distribution, not just retail panic. Money is leaving consumer stocks and moving into the safety of the technology sector or hiding in cash. Until consumer discretionary stabilizes, the broader market rally feels hollow.
Finally, let's address the risk indicator everyone is ignoring, the Russell 2000 IWM. It's up only 0.57% to $302.71, while QQQ is up 0.73%. Grid, you warned about $300. What's happening there?
IWM is hovering at $302.71, dangerously close to the psychological $300 barrier and the August 12 low of $301. The fact that it is only gaining 0.57%, while QQQ is gaining 0.73% shows a lack of conviction. Small caps require credit access to grow, with the yield curve flat at plus 0.48 pp. Banks are tightening standards. IWM is showing the first cracks of liquidity drying up. If we break $300, we could see a rapid acceleration to the downside because there are very few buyers left in that sector. It's a high beta indicator, and it's telling us that the risk-on trade is turning off.
And that is the smoking gun. IWM breaking $300 is not a technical glitch. It's a confirmation of credit stress. The Magnificent Seven can borrow cheaply and maintain operations. Small caps cannot. The fact that IWM is lagging so badly behind QQQ confirms that this rally is artificial. It's driven by balance sheets, not income statements. Once the credit cycle turns fully negative, the narrow breadth of this SPY rally becomes a liability, not an asset. The S&P 500 looks fine because it's weighted toward companies that can survive a recession. The rest of the market, IWM, Consumer Discretionary Communication Services, is already in it.
So we have a market held together by tape. Tech is strong, fundamentals are weak, and the breadth is vanishing. Apex, bring it home. How do we navigate this Tuesday session?
Navigating this requires a shift from index trading to stock picking. The SPY at $772.49 is a distractor. It looks stable, but that stability is purchased by neglecting half the market. Here is the synthesis. Grid identified that SPY support at $771.28 is critical, but CIPHER showed that this support is built on the technology sector's plus 1.49% surge, which is fundamentally unsupported by the 1.5% GDP growth figure. Pulse highlighted the sentiment trap in NVDA, where hedging is increasing despite the price climb. And SPECTER correctly pointed out that IWM's struggle at $300 confirms credit tightening. The takeaway is simple: do not chase the SPY high. Watch the breakdown of IWM below $300 as the leading indicator. If small caps surrender, the tech rally loses its shield. Stay in the quality growth of the technology sector, but reduce exposure to consumer discretionary and communication services. The market is narrowing, and narrow markets eventually break.
Let's review the key takeaways from this midday update. First, the S&P 500 stability at $772.49 is illusory, driven entirely by a plus 1.49% surge in technology, the technology sector, while consumer discretionary, and materials, the materials sector bleed. Second, the technical structure of QQQ at $723.70 is consolidating tightly between $720.33 and $727.25, but the lack of breadth makes it vulnerable to sentiment shifts. Third, the Russell 2000 failure to outpace large caps, trading at $302.71 while struggling near $300, signals emerging credit stress and liquidity constraints. Tomorrow, watch for a potential retest of the SPY $771.28 support level and monitor whether IWM can hold the $300 psychological barrier. Any break there accelerates the risk-off narrative. Thanks for listening to the ShadowQuant Equities edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.